The constant flicker of the screen. Green up, red down. A headline flashes, a talking head shouts, a graph spikes, and with it, your heart rate, your wealth, your future, your peace of mind, all tethered to that frantic, unpredictable dance of numbers. You check it in the morning when you wake up, a quick glance at the pre-market. You check it on your lunch break. You check it again before the closing bell, a ritual of hope or anxiety. You've been told this is what diligent investors do. You've been told that staying informed is the key to success. But what if that diligence is a delusion? What if the very act of watching, of being so engaged, is the single greatest barrier to your own wealth building? What if the secret to winning the game is to stop watching the scoreboard so closely? There is a man in Omaha, Nebraska who has built one of the greatest fortunes in human history by following a radically different philosophy. Warren Buffett, over a span of more than 60 years, has compounded wealth at a rate that defies logic. And he has done it not by trading faster, not by having more complex algorithms, but by doing almost the opposite. He checks his portfolio with the frequency a farmer might check on a grove of oak trees he planted years ago. He understands a profound truth that eludes 99% of market participants. You cannot get a baby by weighing it every day. Some things require time, patience, and a fundamental shift in perspective. This is not a story about a stock tip. It is not a secret formula or a get-rich-quick scheme. It is the story of a mental transformation, an evolution from a frantic stock renter to a calm, resolute business owner. Buffett doesn't see tickers. He sees fractional stakes in real, breathing, operating businesses. He doesn't buy blips on a screen. He buys pieces of companies. A true business owner doesn't frantically call their accountant every 5 minutes to get a new valuation on their local hardware store. They focus on whether the store is selling more hammers and nails this year than it did last year. They focus on the fundamentals of the business, not the fleeting mood of the neighborhood. The costly mistake this mindset prevents is the plague of the modern retail investor: overtrading. It's the churn driven by fear, greed, and the endless stream of market noise. It's the pattern of selling your best assets during a panic and buying into a frenzy at the peak, all while racking up transaction costs and capital gains taxes that act as a silent parasite on your returns. The financial transformation that awaits you is not just a larger account balance. It is a profound sense of calm. It is the freedom from the anxiety of daily market fluctuations. It is the temperament to hold great companies long enough to let the miracle of compounding do its work, turning significant gains into life-changing wealth. This is the journey from gambler to proprietor. This is the bedrock of portfolio growth, the essential first step toward true and lasting financial freedom. We begin with the most critical shift of all, the foundational act of rewiring your brain to see the world not as a trader, but as an owner. This isn't just semantics. It is the core of the entire philosophy. It's the difference between renting an apartment and owning a home. The renter worries about the daily annoyances, the leaky faucet, the noisy neighbors. The owner thinks in decades. They think about the foundation, the structure, the long-term value of the asset. They are invested, emotionally and financially, in the underlying health of the property, not the daily gossip on the street. To understand how deeply this principle runs, we must travel back to a moment of crisis, a moment of panic in the market that created one of the greatest investment opportunities of the 20th century, an opportunity visible only to someone who could see a business where everyone else saw a scandal. The year was 1963. The world was a different place, but the psychology of markets was exactly the same. American Express was a titan, a blue-chip institution synonymous with trust. Its core businesses were rock solid. Traveler's checks, a precursor to the modern credit card, were a global necessity for anyone venturing abroad. Their brand was impeccable. But American Express had a small, almost forgotten subsidiary in the business of field warehousing. They would inspect a company's inventory, like barrels of oil or tons of steel, and then issue receipts against that inventory. Other banks would then lend money to the company, using these Amex-issued receipts as collateral. It was a mundane, profitable little business built entirely on American Express's sterling reputation for integrity. Then came the scandal. A small, unassuming company in New Jersey called the Allied Crude Vegetable Oil Refining Corporation, run by a charismatic fraudster named Tino DeAngelis, was one of American Express's clients. DeAngelis had devised a brilliant scheme. His massive storage tanks were supposed to be filled with valuable salad oil. He would get the American Express receipts, get loans from dozens of banks, and use the money to speculate on commodity futures. The problem was, the tanks were mostly filled with seawater, with only a thin layer of salad oil floating on top. When the inspectors from American Express came, they would dip their measuring sticks in, see oil, and sign off. Tino had conned them all. When the fraud was discovered, it was catastrophic. Allied Crude Vegetable Oil went bankrupt, defaulting on an estimated $175 million in loans, an astronomical sum at the time. The banks that held the worthless receipts turned to the one entity with deep pockets and a reputation to protect, American Express. The market panicked. The ticker symbol, AXP, was radioactive. Wall Street's logic was simple and brutal. American Express was on the hook for the entire $175 million. Their reputation was shattered. The stock plunged nearly 50%, wiping out hundreds of millions in shareholder value in a matter of days. The herd was stampeding for the exit. This was the epitome of a scandal stock, a falling knife that no sane person would try to catch. But Warren Buffett was not a typical Wall Street player. He was a business owner. And as a business owner, his first question wasn't, how much lower will the stock price go? His question was, how is the actual underlying business being affected? He didn't see a ticker in freefall. He saw two distinct businesses. One was a tiny, flawed field warehousing division that had made a terrible mistake. The other was the colossal, dominant global payments business of travelers' checks and credit cards. The market, in its panic, was lumping them together and pricing the entire company for disaster. So Buffett did what a prospective business owner would do. He conducted his own, real-world due diligence. He didn't just read analyst reports or look at stock charts. He went to the source. He walked into banks in his hometown of Omaha. He talked to the tellers. He went to travel agencies. He visited restaurants and hotels. He would stand in line and observe. He asked them simple questions. Has this salad oil scandal changed your willingness to accept American Express travelers' checks? Are your customers still using the cards? The answer, universally, was no. People didn't care about a weird story involving salad oil in New Jersey. They cared that their travelers' checks were accepted in Paris and that their credit card worked at their favorite steakhouse. The core business, the real engine of value, was completely unharmed. The brand's power with the end consumer was intact. Armed with this on-the-ground knowledge, Buffett did the math. He realized that while the potential liability was large, American Express was a money-gushing machine that could easily earn its way out of the problem over a few years. The market was pricing it for bankruptcy, but the business itself was thriving. He saw a world-class business on sale for a ridiculous price because of a temporary survivable problem in a non-core division. He instructed his partnership to invest aggressively, eventually putting 40% of their entire capital into American Express stock. It was the largest investment he had ever made. Within a few years, the stock had risen fivefold. The salad oil scandal became a footnote in history, but it served as a masterclass in the business owner mindset. While everyone else was reacting to the ticker, the headline, the scandal, Buffett was quietly evaluating the business. He was an owner, not a renter. This story reveals the powerful psychological currents that Buffett was swimming against. The market's reaction to the salad oil scandal was a textbook case of herd mentality. When a stock starts to fall dramatically, our primitive survival instincts kick in. The herd is running, so we must run too, lest we be left behind to be devoured by the predator. In financial markets, the predator is the fear of further losses. Seeing your friends, your colleagues, the experts on TV, all selling a stock creates immense social pressure to conform. To stand apart and buy when everyone else is selling feels unnatural, dangerous, and lonely. It requires a deep-seated conviction that the herd is wrong. Buffett was able to achieve this because his conviction wasn't based on an opinion about the stock price. It was based on his factual analysis of the business's health. Furthermore, the crisis was amplified by the framing effect. The media and Wall Street had framed American Express as a scandal stock. That frame colored every piece of information. Every price drop was seen as confirmation that the company was doomed. The narrative was one of disaster. Buffett reframed the situation entirely. He saw it not as a scandal, but as a, quote, great business with a temporary and solvable problem. By changing the frame, he changed the emotional response from fear to opportunity. The average investor is a captive of the market's frame. They see a stock that's down 50%, and their brain screams, danger, mistake. A business owner sees a company whose earning power is unchanged, but whose price tag has been cut in half, and their brain whispers, opportunity, bargain. This is the psychological pivot upon which fortunes are built. It's an override of our most basic and most costly emotional investing instincts. So how can you, in your own financial life, replicate this monumental shift in perspective? It starts with a practical mental model, an exercise I call the front page test. This is your blueprint for transforming from a ticker watcher into a business analyst. First, pick one of the stocks you currently own, preferably one you feel a bit anxious about. Now perform a thought experiment. Imagine that tomorrow, by some strange decree, its ticker symbol and stock price are erased from every screen on the planet. You cannot look it up. Furthermore, you are forbidden from selling your shares for the next 5 years. You are locked in, just like the owner of a private company. The only information you will receive about your investment will be the company's official quarterly and annual reports, the same documents the CEO sends to all owners. Now ask yourself with brutal honesty, how does that scenario make you feel? Are you terrified or are you comfortable? If you feel a wave of panic, it is a clear sign that you are a stock renter, deriving your confidence from the daily validation of a rising stock price. Your conviction is price-based and therefore fragile. If, however, you feel a sense of calm, your confidence is likely business-based. Your next step in the exercise is to define what, in those future reports, would actually matter to you. Forget the stock price. What specific business metrics would tell you your investment was healthy? Would it be revenue growing at more than 10% per year? Would it be profit margins expanding? Would it be the company paying down its debt? Write these 3 or 4 key metrics down. This is your new dashboard. This is what a true owner watches. This exercise forcibly unplugs you from the noise of the market and plugs you directly into the fundamentals of the business. It makes the abstract concept of ownership tangible and real. If the thought of being locked into a business for 5 years without a price, quote, terrifies you, you probably shouldn't own it for 5 minutes. To truly appreciate the power of this approach, we must examine its antithesis, the path walked by the overwhelming majority of market participants. This is the path of the 99%. Consider the modern Robin Hood trader, a symbol of our hyper-connected, information-saturated era. Their experience of the market is the screen. Their reality is the ticker, the graph, the constant stream of P&L notifications. They are not owners. They are the most transient of renters, sometimes holding a position for mere hours or even minutes. Their decisions are driven by algorithms they don't understand, news alerts that lack context, and the social media buzz from anonymous influencers. They see a stock like GameStop, a struggling brick-and-mortar video game retailer, soar from $17 to over $400 in a matter of weeks. The business fundamentals were irrelevant. In fact, they were deteriorating. The only thing that mattered was the story, the momentum, the ticker. They were renting a rocket ship, not investing in a business. The inevitable outcome for most who joined this frenzy was catastrophic. They bought into the narrative at the peak, fueled by greed and a fear of missing out, and rode it all the way down. Their mistake wasn't just bad timing, it was a complete failure to ask the fundamental business owner question: what is the actual underlying business I am buying, and what is it worth? They weren't buying a business at all. They were betting on a number, a blip on a screen, hoping another person would come along and pay a higher price for it. This is not investing. It is the greater fool theory in action. This approach, this obsession with the ticker, creates a state of perpetual anxiety and leads to a pattern of disastrous decision-making. It is the fast lane to financial disappointment, a clear illustration of what happens when you substitute the hard work of business analysis with the cheap thrill of speculation. The financial connection here is not abstract, it is brutally direct and quantifiable. The path of the 99% is a path of self-inflicted financial friction. Let's put numbers to it. Every time you trade, you incur costs. There are the obvious ones, like commissions, though many brokers now offer zero-commission trades. But the hidden costs are far more venomous. There's the bid-ask spread, the tiny difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. When you trade frequently, these tiny cuts add up to a gaping wound over time. But the most significant cost, the one that truly separates the business owner from the trader, is taxes. In the United States, if you hold an asset for less than a year, any profit is taxed as a short-term capital gain, which is taxed at your ordinary income tax rate, as high as 37%. If you hold that same asset for more than a year, it qualifies as a long-term capital gain, with a tax rate that is dramatically lower, typically 15% or 20% for most people, and even 0% for some income brackets. Imagine a $10,000 investment that grows by 15% in a year. The stock renter, who gets excited and sells within 12 months, might pay $555 in taxes on their $1.500 gain, assuming a 37% bracket. The business owner, who holds on for another day to cross the one-year threshold, might pay only $225 at a 15% rate. That's more than double the tax bill for a single day's difference in patience. Now multiply that effect over dozens of trades and decades of investing. The constant churn of buying and selling not only prevents the magic of compounding from taking root, but also ensures that you are continuously handing over a huge slice of your profits to the government. The business owner mindset isn't just a psychological trick to keep you calm. It is a deliberate strategy to maximize after-tax returns, a cornerstone of serious wealth building and the most direct path to portfolio growth. It is the first, most fundamental law of long-term investing. Once you have made that foundational shift from ticker renter to business owner, the next logical question arises: how does a business owner decide which businesses to buy? They don't chase fads or listen to rumors. They engage in a rigorous process of due diligence, focusing on the long-term durable characteristics of a company. They buy the business, not the story that Wall Street is selling. This principle is about separating the substance of a company from the seductive but often misleading narratives that surround it. To truly grasp this, we must look at one of Buffett's most illuminating purchases, not of a stock, but of an entire company, a purchase that taught him more about investing than almost any other. It was the acquisition of See's Candies in 1972. At the time, Berkshire Hathaway was still primarily a struggling textile business. Buffett and his partner Charlie Munger were looking to deploy their capital into better ventures. A banker brought them a deal. A family-owned premium chocolate company based in California called See's Candies was for sale. On the surface, it looked unimpressive to a conventional value investor. The company had tangible assets, factories and stores, worth only about $8 million, yet the See family was asking for $25 million. A traditional analyst would have walked away immediately, refusing to pay such a high premium over the book value. But Buffett and Munger were evolving their thinking. They were starting to think not just like investors hunting for statistical bargains, but like proprietors looking to buy wonderful businesses. So they did their homework. They dug into the financials and saw a company that produced consistent profits and required very little new capital to grow. But their most important research didn't happen in an office. They understood that the true value of See's Candies wasn't in its factories. It was in the minds of its customers. They recognized the power of the brand. For decades, See's had been the go-to gift in California for birthdays, Valentine's Day, and Christmas. Giving a box of See's was a gesture of affection and quality. A young man taking a box of chocolates to his new girlfriend's parents wasn't going to risk saving $1 on a generic brand. He bought See's to make a good impression. This brand loyalty gave the company a powerful, competitive advantage, what Buffett would later popularize as an, quote, economic moat. Crucially, this moat gave See's something magical: pricing power. Each year, they could raise the price of their chocolates by a little bit, and their customers wouldn't blink. The cost of sugar and labor might go up, but See's could pass those costs along and then some, and people would happily pay because the experience and the brand were worth it. Buffett realized he wasn't just buying buildings and candy-making equipment for $8 million. He was buying an intangible asset of immense value, a decades-long relationship of trust and affection with millions of customers. He and Munger paid the $25 million. Over the years, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring minimal new investment. It was, as Buffett has said, a dream business. The lesson was profound. The most important assets of a company don't always show up on the balance sheet. A great story might get a stock to pop for a week, but a great business with a durable moat can make you rich for a lifetime. The See's Candies story is a powerful antidote to a dangerous cognitive bias known as the narrative fallacy. As humans, we are wired for stories. Our brains are not spreadsheet machines, they are narrative processors. A compelling story about a visionary founder, a disruptive technology, or a world-changing mission is far more persuasive to us than a dry table of historical cash flows. The narrative fallacy is the tendency to create and believe coherent stories to explain random or complex events. In investing, this leads us to fall in love with story stocks, companies with a great narrative but often terrible or unproven business models. We invest in the story, not the reality. Buffett's discipline is to actively resist the seduction of narrative. He is drawn to businesses that are often boring but incredibly predictable: a candy company, an insurance firm, a railroad. Their stories aren't exciting, but their business models are understandable, and their cash flows are reliable. He prioritizes the boring spreadsheet over the exciting story, a discipline that runs counter to our natural human wiring. This is often compounded by overconfidence bias. After a few successful investments, or after reading a few articles, we start to believe we are better at picking stocks than we actually are. This overconfidence makes us susceptible to complex narratives we don't truly understand. We convince ourselves we can identify the next Amazon or the next Tesla, venturing far outside our areas of expertise into highly speculative ventures. The investor who falls for the narrative fallacy, powered by overconfidence, is buying a lottery ticket with a great marketing campaign. The business owner, like Buffett with See's, is buying a proven, cash-generating machine, even if the story behind it is as simple as selling chocolate. To operationalize this principle and avoid the narrative trap, you need a structured approach to due diligence. The blueprint for this is a mental model I call the 5-year owner's memo. Before you even consider buying a single share of a company, you must sit down and write a 1-page memo to yourself, as if you were justifying the purchase of the entire company to a board of directors. This memo must have 3 distinct sections. Section 1 is the moat. In simple, clear language that a 10-year-old could understand, you must describe why this business is protected from competition. What prevents a new, well-funded rival from coming in and eating their lunch? Is it a powerful brand like Coca-Cola? Is it a patent on a critical drug? Is it a network effect like Facebook, where the service becomes more valuable as more people use it? Is it a low-cost advantage like Geico or Costco? If you cannot clearly articulate the company's competitive advantage, you should not be an owner. Section 2 is the management. A business is only as good as the people running it. Your job as a prospective owner is to assess their quality. Go and read the last 3 years of the CEO's annual letter to shareholders. Is the CEO candid and honest about the company's challenges and mistakes? Or is the letter filled with corporate jargon and blame shifting? Do they have a clear, long-term strategy, or are they just reacting to short-term pressures? Finally, look at their compensation. Is the management team paid based on long-term performance metrics like return on equity, or are they rewarded for short-term stock price bumps? You want to partner with managers who think and act like owners themselves. Section 3 is the price. A wonderful business is not a wonderful investment if you overpay for it. In this section, you must make a conservative estimate of the company's intrinsic value. What is the entire business reasonably worth? You can do this with simple models, like looking at its current earnings and applying a conservative multiple based on its growth prospects. Then, compare your estimate of intrinsic value to the company's current market capitalization, the total value of all its shares. Does the current price offer a significant discount, a margin of safety to your calculated value? Investing is most successful when it is most businesslike. This memo forces you to think like a business owner, to analyze the qualitative aspects of the moat and management, and the quantitative aspect of price and value. It is your shield against the siren song of empty narratives. The antithesis to this rigorous business-focused approach is the path of the story stock chaser. This is the investor who buys the sizzle, not the steak. The annals of financial history are littered with the wreckage of companies that had incredible stories but fundamentally broken businesses. Think of a company like WeWork. The narrative was intoxicating. A charismatic founder, a mission to elevate the world's consciousness, and a story about changing the very nature of work. The company was heralded as a revolutionary tech firm, not a simple office rental company. Investors, from small retail traders to massive sovereign wealth funds, poured billions of dollars into this story, pushing its private valuation to a staggering $47 billion. But anyone who took the time to write an owner's memo would have seen the glaring red flags. The moat? There was none. Competitors could and did offer similar flexible office spaces. The management? The founder's erratic behavior and the company's profligate spending were well documented for anyone who cared to look beyond the hype. The price? The company was losing billions of dollars a year with no clear path to profitability. It was a simple, unprofitable real estate company masquerading as a high-growth tech superstar. When the company tried to go public, the harsh light of financial scrutiny caused the narrative to collapse, and the valuation plummeted by over 90%. Those who bought the story lost their shirts. Those who analyzed the business stayed a million miles away. This is the stark difference between investing based on a seductive narrative and investing based on a sober assessment of business fundamentals. The direct financial connection here is the crucial distinction between market price and intrinsic value. The market price is what a stock is trading for today. It is a reflection of supply and demand, of fear and greed, of narratives and news headlines. It is often emotional and irrational in the short term. Intrinsic value, on the other hand, is an estimate of a business's true underlying worth, based on its ability to generate cash for its owners over its lifetime. The goal of a business owner-investor is to identify a gap between these two figures, to buy a business when its market price is significantly below its calculated intrinsic value. This gap is the famous margin of safety, popularized by Buffett's mentor, Benjamin Graham. Your due diligence, your owner's memo, is your tool for estimating intrinsic value. When you do the work, you gain the confidence to buy when others are fearful, because you know you are purchasing a dollar's worth of business for 50 cents. Over the long run, market prices are tethered to intrinsic value. As a company's earnings and cash flow grow, its intrinsic value increases, and eventually, the market price has to follow. A helpful analogy is to think of the business's intrinsic value as a person walking their dog on a leash. The person intrinsic value walks forward in a relatively straight, predictable line. The dog, the stock price, runs all over the place, chasing squirrels, sniffing trees, running ahead, and falling behind. But no matter how erratic the dog's path, it is ultimately tethered to the owner and will end up at the same destination. The trader tries to guess the dog's next move. The business owner focuses on where the person is walking. This focus on intrinsic value is the foundation of value investing and the most reliable engine for long-term capital gains and wealth building. You've made the mental shift to become an owner. You've learned how to perform the due diligence required to buy a great business at a fair price. Now comes the hardest part of all, the part that requires not intelligence, but temperament. You must master the art of inactivity. A true proprietor, having bought a wonderful local business, does not put a for sale sign in the window the next day because of a bad weather forecast or a negative news report about the national economy. They have a long-term perspective. They understand that the value of their enterprise will be realized over years and decades, not days and weeks. In the world of investing, this translates to the patience of a proprietor, the ability to hold on to your great businesses through the inevitable storms of market volatility. For the perfect illustration of this principle, we must go to 1973. The American economy was in turmoil. The country was mired in the Watergate scandal, facing an oil crisis and sliding into a painful recession. The stock market was collapsing in what would become one of the worst bear markets in its history. It was a time of deep pessimism and fear. Amidst this chaos, Warren Buffett found an opportunity. He began investing in the Washington Post Company. To the rest of the market, newspapers were a terrible business to be in. They were under political attack due to Watergate, and their advertising revenue was vulnerable to the looming recession. The stock was deeply unloved and undervalued. Buffett, applying his business owner mindset, saw a different reality. He saw a dominant media institution in a major city. The Washington Post was the paper of record in the nation's capital. It had a virtual monopoly on information for the most powerful people in the world. It had a durable brand and a deep connection with its readers. It was, in his view, a franchise, an economic castle with a deep moat around it. He invested about $10 million, acquiring a significant stake in the company. Then, the market continued to plunge. Over the next 2 years, the value of his investment was cut almost in half. The stock price fell from what he thought was a bargain to what looked like an absolute disaster. A typical stock renter would have panicked. Their brain would be screaming, "I made a mistake, I need to get out before I lose everything." Their conviction based on the stock price would have shattered. But Buffett's conviction was not in the stock price, it was in the business. He didn't sell, he did nothing. He knew the business of the Washington Post was still sound. He knew its competitive position was still intact. He knew that the market's short-term pessimism did not change the long-term earning power of the company. So he waited and waited. Over the next 30 years, that $10 million investment, which was temporarily worth only $5 million, blossomed into a holding worth over $1 billion. That is a 100-fold return. This legendary success was not the result of a brilliant buy decision alone. It was the product of a brilliant buy decision combined with the iron-willed patience to do nothing, to let the business do the work. A perfect demonstration of the power of a buy-and-hold strategy. The immense difficulty of holding on through such volatility is rooted in one of the most powerful and destructive psychological biases we possess: loss aversion. Pioneering work by psychologists Daniel Kahneman and Amos Tversky showed that, for the human brain, the pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. Losing $100 feels twice as bad as finding $100 feels good. This is likely an evolutionary holdover. For our ancient ancestors on the savannah, failing to notice a potential reward, some berries on a bush, was not a big deal. But failing to notice a potential threat, a lion in the grass, was catastrophic. Our brains are therefore exquisitely tuned to avoid losses. In the stock market, this wiring is a disaster. When we see our portfolio's value drop even by a small amount, our loss-averse brain screams danger. This is magnified by a related effect called myopic loss aversion. The myopic part refers to how frequently we check our investments. The more often you look at your portfolio, the more likely you are to see a temporary loss. Each time you see that red number, you experience a pang of pain from loss aversion. Checking your portfolio daily is like giving yourself hundreds of small, painful electric shocks every year. Eventually, your brain can't take it anymore, and you sell at the worst possible time during a market dip, just to make the pain stop. Buffett's strategy of rarely checking his stocks isn't a sign of carelessness. It is a sophisticated psychological defense mechanism against his own brain's worst instincts. He is deliberately managing his own emotional investing triggers. To build this same defense mechanism, you need a practical system for enforcing patience. This blueprint is the portfolio hibernation strategy. It is a three-part plan to master the art of inactivity and make it your greatest strength. The first part is to create a written investment policy statement, or IPS. This is a short document, no more than a page, that you write for yourself in a moment of calm rationality. It outlines your financial goals, your time horizon, and your fundamental strategy. Most importantly, it must contain a strict set of rules for when you are allowed to sell a stock. A good rule would be, I will only sell a holding if the original business reason for my purchase has been fundamentally broken, e.g., the company has lost its competitive moat, or if I find a new investment that is dramatically more attractive and undervalued. Crucially, you must explicitly forbid selling based on market panic or stock price declines. Your IPS is your constitution, a contract with your future, more emotional self. The second part is to schedule your portfolio check-ins. Instead of looking at your account whenever you feel anxious or curious, you must treat it like a doctor's appointment. Decide on a reasonable frequency, perhaps once a quarter, or even just twice a year. Put these dates on your calendar, January 1st and July 1st, for example. These are the only days you are allowed to log in and review your holdings. This active scheduling transforms portfolio review from an emotional, reactive habit into a disciplined, proactive process. The third and final part is to automate everything. The most powerful way to be inactive is to let machines do the work. Set up automatic, recurring investments from your paycheck into your chosen companies or low-cost index funds. This is known as dollar-cost averaging. By automatically buying on a regular schedule, you remove all emotion and timing from the equation. You buy more shares when prices are low and fewer shares when prices are high. This transforms your planned inactivity from a passive state into a powerful, automated wealth-building engine, a core component of generating long-term passive income. The antithesis of the patient proprietor is the market timer. This is the person who believes they are clever enough to dance in and out of the market, selling at the tops and buying back in at the bottoms. They listen to the pundits who declare that a crash is coming, so they sell everything and move to cash, feeling smart and safe. Then, after the market drops and eventually recovers, they wait for a clear, all-clear signal to get back in. The problem is, this signal never comes. The market's biggest recovery days often happen in the midst of maximum fear and uncertainty. By the time the market feels safe again, the lion's share of the gains has already been missed. The data on this is not just compelling, it is damning. Studies have repeatedly shown that missing just a handful of the market's best days can devastate your long-term returns. For example, an analysis by J.P. Morgan Asset Management found that from 1999 to 2018, if an investor stayed fully invested in the S&P 500, they would have earned an annualized return of 5.62%. However, if that same investor missed just the 10 best trading days during that 20-year period, their return plummeted to 2.01%. Miss the 20 best days, and their return was negative. The market's best days are often clustered right around its worst days. The market timer, in trying to avoid the pain of the worst days, almost guarantees they will also miss the massive gains of the best days. Their attempt to be clever ensures their own mediocrity. This proves that the old cliché, "It's time in the market, not timing the market," is not just folksy investment advice. It is a mathematical and psychological imperative for any retail investor seeking financial freedom. The direct financial connection of this pillar is the most powerful force in the universe, according to Einstein, the power of compounding. Compounding is the process of your earnings, from interest or capital gains, generating their own earnings. It is a snowball effect. A small sum of money, given enough time and a reasonable rate of return, can grow into a fortune. Let's visualize this. A one-time $10,000 investment earning 10% per year will grow to about $26,000 in 10 years. In 20 years, it becomes $67,000. In 30 years, it swells to over $174,000. The growth is not linear, it is exponential. The real magic happens in the later years. Now see what happens when the market timer or the frequent trader interrupts this process. Every time they sell a winning position, they stop the compounding. They must then pay capital gains taxes on their profit, which permanently removes that capital from their snowball. When they buy back in, they are starting over with a smaller base of capital. Their constant activity acts as a massive brake on the compounding engine. The patient proprietor, the one who does nothing, allows the compounding machine to run uninterrupted for decades. Their inactivity is the fuel. Their patience is the accelerant. This understanding, that the biggest returns come not from brilliant moves but from the long, uninterrupted runway of time, is what separates amateur portfolio management from professional wealth building. Patience isn't just a virtue, it is a financial superpower. We've established the mindset of an owner, the due diligence process, and the critical importance of patience. The next pillar addresses a fundamental question. If you're not watching the stock price, how do you measure success? How do you know if your investment is working? A true business owner judges their asset by its operational performance, not by the market's daily opinion of it. They focus on earnings, not on price. This means shifting your entire scorecard, moving your attention away from the volatile, noisy stock chart and onto the boring but truthful financial statements. Your metric for success must be the progress of the business itself. There is no better example of this principle in action than Buffett's iconic, multi-decade investment in the Coca-Cola Company. He famously began buying the stock in 1988, shortly after the Black Monday market crash of 1987. The market was still gripped by fear, but Buffett, as usual, was analyzing the business. He saw a company that was almost perfect. It sold a simple, beloved product. It had a global distribution network that was virtually impossible to replicate. And its brand was one of the most powerful on earth, embedded in the culture of hundreds of countries. He saw a business with predictable and growing earnings that was, thanks to the market crash, selling for a very reasonable price. He invested over $1 billion, making it one of Berkshire's largest holdings. Now, consider the journey of that investment. Over the subsequent 30-plus years, the world has gone through countless crises. There was the dot-com bust, the 9/11 attacks, the 2008 financial crisis, the Eurozone debt crisis, and the COVID-19 pandemic. There were endless health scares about sugar, the rise of new competitors, and dramatic shifts in consumer tastes. Through all of this, the stock price of Coca-Cola has experienced extreme volatility, with periods of stagnation and sharp declines. A stock renter, watching the price gyrate, would have been tempted to sell 100 times over. But Buffett's focus was never on the stock price. His focus was on the business report card. Each quarter and each year, he asked a simple set of questions. Is Coca-Cola selling more cases of its beverages this year than last year? Are its profit margins stable or improving? Is its global brand presence getting stronger? Is it generating more cash for its owners? He would find the answers to these questions not on a stock chart, but in the pages of the company's annual report. As long as the answers to those questions were yes, the daily fluctuations of the stock price were completely irrelevant. They were just noise. He understood that as long as the business's earnings per share were on a steady upward trajectory, the stock price would eventually have to follow. He judged the investment by the business's performance, not the market's mood. This unwavering focus on the underlying fundamentals is what allowed him to hold on and reap a truly staggering return on his initial investment. The reason most investors fail to do this is because they are susceptible to two powerful cognitive biases: anchoring bias and the availability heuristic. Anchoring bias is our tendency to rely too heavily on the first piece of information we receive. For most investors, that anchor is the price at which they bought a stock. If the price drops below their purchase price, their brain immediately interprets it as a failing grade. They feel they've made a mistake, even if the company's revenues and profits are growing faster than ever. Their ego is tied to the purchase price, preventing them from objectively assessing the health of the business. The availability heuristic compounds this problem. This bias causes us to overestimate the importance of information that is recent and easily recalled. A scary headline on the front page of the Wall Street Journal, a dramatic cable news segment about a market dip, or a friend panicking about their 401k. This information is vivid, emotional, and readily available. The data in a company's 10Q report, revenue growth, debt-to-equity ratios, free cash flow, is by contrast dry, complex, and requires effort to find and understand. Consequently, we overweight the dramatic, available information, the stock price and news, and underweight the more important but less available information, the business fundamentals. Buffett's genius is his disciplined ability to invert this, to ignore the easily available noise and focus entirely on the hard data of business performance. To build this discipline yourself, you can implement a mental model called the business report card. This is a simple, structured process for reviewing your holdings that completely ignores the stock price. At the end of each quarter, when your companies release their earnings reports, you will become the principal of your own portfolio. For each company you own, you will pull up its latest report. You will not look at the stock chart. Instead, you will grade the company's performance based on the 3 to 5 key business metrics you established in your owner's memo when you first bought it. For example, if you own a software company, your metrics might be: 1. Is revenue growing at over 15% year over year? 2. Is the company adding new customers at a healthy rate? 3. Are its gross margins above 80%? You will go through the report, find the numbers, and give the company a simple grade, an A, B, C, or even a pass/fail. The decision to continue owning the business should be based on this report card. If the company is consistently getting A's and B's, you hold on, regardless of what the stock price is doing. If it starts getting D's and F's for multiple quarters in a row, it means your original thesis might be broken, and it's time to consider selling. This process systematically forces you to think like a business owner. You are judging your asset on its results, not on its popularity contest, which is all the stock market is in the short run. This stands in stark contrast to the approach of the 99%, particularly those who fall into the camp of pure technical analysis. The technical analyst believes that all the information about a company is already reflected in its stock price and trading volume. Their world is the chart. They don't care about earnings, products, or management. They look for patterns in the price movements, formations with esoteric names like Head and Shoulders, Double Bottoms, or the Golden Cross. They believe these patterns can predict the future direction of the stock price. While some short-term traders can find success with these methods, for the long-term business owner this approach is a complete distraction. It is an attempt to find order in what is largely random short-term noise. It's like trying to predict tomorrow's weather by looking at the shapes of the clouds today, while completely ignoring the larger climate system of the seasons. The business owner, the fundamental analyst, is studying the climate. They know that if it's summer, the company is profitable and growing, the weather will generally be warm, even if there are a few unexpectedly cold days. The technical analyst is obsessed with the daily weather and often gets caught in the rain. By focusing only on price, they are looking at the effect, while the business owner is focused on the cause, the earning power of the business. The financial connection that underpins this entire pillar is the relationship between earnings per share (EPS) and the price-to-earnings (PE) ratio. This is how the abstract concept of business performance gets translated into tangible stock market value. A company's job is to generate profit or earnings for its owners. Earnings per share is simply the company's total profit divided by the number of shares outstanding. It tells you how much profit the business generated for each individual share you own. The stock's price is, over the long term, a multiple of these earnings. That multiple is the PE ratio. For example, a company with an EPS of $5 and a stock price of $100 has a PE ratio of 20. The key insight for the business owner is this: over the long run, the stock price, the P, is a slave to the earnings, the E. If you own a business that is steadily growing its earnings per share year after year, its stock price must eventually go up. It has no choice. The PE multiple might fluctuate based on market sentiment. Sometimes the market will be optimistic and pay 25 times earnings, and sometimes it will be pessimistic and pay only 15 times earnings. But if the E consistently grows, the P has to follow it higher. By making the growth in business earnings your primary metric for success, you anchor yourself to the engine of long-term value creation. You liberate yourself from the emotional roller coaster of the fluctuating PE multiple and position yourself to capture the massive capital gains that come from owning truly great and growing businesses. We have now arrived at the final and perhaps most crucial pillar of the business owner mindset. It is the principle that ties everything together and provides the ultimate source of an investor's advantage. It is the discipline to operate only within your circle of competence. A true business owner would never dream of buying a business they did not fundamentally understand. The owner of a successful chain of pizzerias would not suddenly decide to buy a semiconductor manufacturing plant. They would recognize that they have no expertise in that field, no ability to judge the quality of the business or the competence of its management. They would have no edge. The same discipline must apply to your investments in the stock market. You must only buy pieces of businesses that you are capable of understanding. The most dramatic and wealth-preserving example of this principle in Buffett's career was his famous refusal to participate in the dot-com bubble of the late 1990s. The world was going crazy for technology, internet, and telecom stocks. Companies with no profits, no revenues, and often no viable business plan were going public and seeing their stock prices multiply overnight. It was a mania, and throughout this period, Warren Buffett was publicly mocked. He was called a dinosaur, an old man who was out of touch, a relic who didn't get the new economy. Barron's magazine famously ran a cover story in 1999 titled, "Warren, What's Wrong?" asking why his old-fashioned approach was failing so badly in this new paradigm. Buffett's response was simple and unwavering. He openly admitted that he did not understand these new business models. He couldn't reliably predict which of the hundreds of new internet companies would be the long-term winners and which would go to zero. He couldn't confidently project their cash flows 10 or 20 years into the future. Because he couldn't understand them, he wouldn't invest in them. It was not a judgment on the technology itself. It was an honest assessment of his own limitations. He was a business owner, and a business owner does not buy what he does not understand. So he stuck to what he knew. Insurance companies like Geico, consumer brands like Coca-Cola, banks like Wells Fargo. While others were gambling on Pets.com, Buffett was patiently tending his garden of understandable, profitable businesses. Then, in March of 2000, the bubble burst. The Nasdaq index, filled with these speculative tech stocks, collapsed by nearly 80% over the next 2 years. Trillions of dollars of speculative wealth evaporated. The companies that had been heralded as the future went bankrupt. The investors who had mocked Buffett lost everything. And Buffett, the dinosaur, was vindicated. His discipline to stay within his circle of competence had not only helped him avoid the catastrophic losses of the crash, but it had preserved his capital, leaving him ready to invest in the bargains that emerged from the wreckage. It was a masterclass in intellectual humility and risk management. The psychological forces that drove the dot-com mania are the very ones that constantly tempt investors to stray outside their circle of competence. The first is the fear of missing out, or FOMO. During a bubble, it seems like everyone around you is getting rich effortlessly. Your neighbor, your coworker, your brother-in-law are all telling you about the money they're making on some hot new stock. This creates an intense psychological pressure to jump on the bandwagon, lest you be left behind. Logic goes out the window, replaced by a primal fear of being the only one not at the party. This is often paired with the Dunning-Kruger effect, a cognitive bias in which people with low ability or knowledge in a particular area tend to overestimate their own competence. A novice investor, having read a few articles or watched a few YouTube videos, might genuinely believe they are qualified to evaluate a complex biotechnology firm or a cutting-edge software company. This toxic combination of FOMO and overconfidence is what leads people to pour their life savings into speculative ventures they know nothing about. They are not investing. They are gambling on a field where they have no edge, and the house almost always wins. Buffett's antidote is a radical form of humility. Know what you don't know and stay away from it. How do you define your own circle? It requires a deliberate and honest process of self-interrogation. This is the blueprint: defining your circle. First, take out a piece of paper and draw a large circle on it. Inside this circle, you will write down the industries and businesses you genuinely understand. Start with your career. If you've been a software engineer for 20 years, you likely have a deep understanding of that industry. If you're a doctor, you understand the healthcare sector. Your profession gives you a massive, unfair advantage in analyzing companies in that field. Second, list your hobbies and deep-seated interests. Are you a passionate gamer who understands the business models of video game companies? Are you a car enthusiast who knows the ins and outs of the automotive industry? These are potential areas of competence. The key test is what I call the explain it to a 10-year-old test. For any company you are considering investing in, could you explain to a child in simple terms exactly how it makes money and why its competitors can't easily put it out of business? If the explanation involves complex jargon or you find yourself stumbling, the company is outside your circle. Finally, and most importantly, you must create a too-hard pile. Be ruthless with this. When you read a company's annual report, if it is filled with technical terms, financial engineering, or business models you can't grasp, throw it in the too-hard pile and move on. There is no penalty for not investing in something. The world is filled with thousands of publicly traded companies. Your goal is not to be a genius who understands everything. Your goal is to avoid being a fool by venturing into areas where you are ignorant. As Buffett says, you only have to be right on a few things in your life, as long as you don't make any big mistakes. The antithesis of this disciplined approach is the hot tip chaser. This is the investor whose portfolio is a random collection of ideas they picked up from others. They buy a junior mining stock because their friend at a barbecue said it was going to strike gold. They invest in a cryptocurrency with a funny name because they saw it trending on a Reddit forum. They buy a biotech stock because a pundit on TV said its new drug trial was promising. This person has no circle of competence. Their decision-making process is entirely external, based on the whims and recommendations of others. They have no personal conviction because they have done no personal research. As a result, when the stock inevitably goes down, they have no basis for deciding what to do. They don't know if the business case has changed or if it's just market noise, so they panic and sell at a loss. Their portfolio is not a curated collection of well-understood businesses. It is a chaotic junkyard of other people's opinions, a surefire recipe for poor asset allocation and long-term financial failure. The direct financial connection of this final pillar is twofold: superior risk management and the potential for alpha generation. Staying within your circle of competence is the single most effective form of risk management an investor can practice. The biggest investment losses don't come from small mistakes in valuation. They come from catastrophic errors in understanding the business itself. By refusing to invest in businesses you don't understand, you dramatically reduce the probability of one of your holdings going to zero and wiping out a significant portion of your capital. It is your ultimate defense. Beyond defense, the circle of competence is also your primary source of offense. In the world of finance, the ability to generate returns that are higher than the market average is called alpha. It is the holy grail of active investing. Your deep knowledge within your specific circle of competence is your best and perhaps only source of generating sustainable alpha. Because you understand your industry better than the average Wall Street analyst, you can spot opportunities that the market is overlooking. You can identify threats to a business long before they show up in the headlines. This informational and analytical edge is how you can beat the market. It's not about having a higher IQ. It's about applying your existing knowledge to a domain where you have a home field advantage. This is the ultimate expression of the business owner mindset, where your unique life experience and professional expertise become the engine of your own executive decision-making and wealth-building strategy. You have just journeyed through the 5 pillars of a profound mental shift. You have installed a new operating system for investing, the business owner mindset. You now possess the framework to detach from the market's daily madness and anchor yourself to the real-world performance of the companies you own. You have the tools to analyze a business, the temperament to hold it through turmoil, the metrics to judge its success, and the discipline to stay within your unique area of expertise. This is a powerful mental arsenal that can transform not just your portfolio, but your entire relationship with money and investing. But this mindset, this powerful lens, is only the first layer of the complete methodology. It's the what and the why. It tells you how to think about an individual business, but how do you apply it systematically across an entire portfolio? How does this principle connect to the art of capital allocation, of knowing when to concentrate your bets in your very best ideas or when to diversify to protect against the unknown? The business owner mindset tells you how to identify a great company, but it doesn't tell you how to construct the fortress that is your financial future. That next step, the architectural blueprint for building that fortress of financial freedom, is what separates a successful investor from a truly wealthy one. It is the bridge between finding a good idea and managing a portfolio of good ideas. And the video that is now on your screen is designed to give you that next piece of the map. It's the critical link that connects the mindset of an owner to the strategy of a capital allocator. The choice is simple. You can leave with this powerful tool and use it in isolation. Or you can click and continue your journey to assemble the complete mental arsenal. The path to wealth building isn't about finding one secret. It's about connecting the pillars of wisdom one by one until the structure is complete. The next pillar is waiting for you. Continue your ascent.